What happened?
Okay, looks like we're good. Looks like we're live.
We're live. We're live and alive and kicking.
Yeah, as long as YouTube says, "Hey, you're live," I'm very happy, because it's like a cockpit on this side. There's like this window for that thing. There's that window for that thing. So I'm glad we're all systems go. How have you been, mate?
Great, awesome, beautiful, wonderful. Yep. Well, it's been raining. Other than that, but today is a bright and sunny day. Other than that, it's been a good season, good time.
Have you been out and about since coming out of lockdown?
Don't ask me about my freedom adventures, because I had just forgotten how good traffic is when everything was. I was thinking we should go back to lockdown. So I have a small, I guess I'll whinge online and live. So we drove to Wollongong, which is not too far from here, just to make it clear to people that it's still within the Greater Sydney area. And man, the place was packed. The place was packed, as in you couldn't find parking. Like, it takes you half an hour to drive there, and then takes you half an hour to find parking. Like, really, like, I mean, that's too much.
What would it have been if you were in lockdown type traffic?
Well, if you're in lockdown and we were not going there, that we couldn't go there if we were in lockdown.
Of course.
But maybe everything should be locked down, but I should be allowed to travel. So I can get some parking somewhere. It was busier than usual. I guess everybody thought, we need to be somewhere, and we're out and about, which I can understand the sentiment. But man, traffic was crazy. The other thing that's back really big time is tailgating.
Oh, okay.
People are tailgating my Tesla. I just don't understand that.
That's yeah. Well, I haven't experienced that in a while, because I was actually filling up at the Bowser the other day, and I realized it was like the first time in months that I've filled up. I only noticed because it was $1.85 at the pump, and I was thinking, geez, this is expensive. But there's just been no one on the roads, right? So there's been no reason to tailgate or to kind of usher people along.
Well, right now, everybody's on the road, right?
That's it. And how about work-wise? What have you been working on the past week?
Well, cooking some recommendations, looking at looking at stocks. It's been exciting times. Just going through my watch list, and the number of companies that I had recommended. They had, some companies had some interesting earnings releases, so that was good. Some secondaries some companies did, which was interesting. What else happened? I had another double of a recommendation that I had made in May. So, I'm not trying to say that it's becoming I almost think it's a problem if you make a recommendation that is, in May, and it doubles between, that's only 5 months, and never make a recommendation thinking it's going to double in like 6 months or a year. But I'll take it when it happens and be happy about it.
I'm sure subscribers love it.
Oh, but here's the thing, right? If you're trying to build a position, you don't want that to happen, right? It's counterintuitive, counterproductive. If you want your position, you increase your position. I guess maybe what has happened is your position has automatically doubled. You didn't have to put any money in, but your position doubled. But if you wanted to make it more than that, then now you have to pay a higher price, right? So I don't know. Those are things that have been happening. Some earnings releases and things like that. So it's fun times. How about you? What's going on? Are you out of lockdown is the number one question.
Today, October 22nd. Yeah, we are out of lockdown, which means that we can go out, but it doesn't, we don't have full liberties. We can't go into many retail stores or anything like that. But we can be seated outside, I believe, for food, and limited seats inside. So we're heading into town tonight. We're about an hour outside of Melbourne. And so we're heading into town tonight to go to a restaurant. I think everything is getting really busy. So naturally, I was riding around my area. I'm just back onto the hills here behind me. And I was riding around my area, and I noticed all of the local restaurants and cafes had tradies outside, fixing up, the outdoor seating arrangements and whatever. so they can accommodate the influx of people. And it's just great to see people out preparing for that, for the businesses preparing too. So just really positive seeing that stuff. But in the last week, I've spent a bit of time. We released a podcast this week with Kate Morris from Adore Beauty. She's the founder of Adore Beauty. So that's a $450 million business now, and she started it probably somewhere between 5 and 10 years before the internet actually arrived. And Adore Beauty is a fully online, basically skincare company where you can go and you can get basically whatever you want from them. And so we talked about the trials and tribulations of that and being early to a market, which is really fascinating. And then over on our other podcast, the Australian Finance Podcast, we took a look at Fortescue Metals, and we just dived into the really popular topic at the moment, which is IPOs, and basically who does what in the IPO zoo. So, what do investment bankers do, and what do underwriters do? And we talked about all those different kind of facets of an IPO process. So that was pretty interesting. But other than that, we've got some company news. We've seen, like, not a company that we've recommended, but we'll talk about it today, which is Magellan Financial Group. We saw a class action being announced against Tyro Payments, which is the terminal payments company here in Australia. And so a few other things, and we've obviously seen a lot of small caps come out with AGMs and quarterlies or AGM, sorry. So that's been really interesting too. A lot of the quarterlies that I've been, AGMs that I've been dealing with. If you just go to the chairman and CEO's address and they issue that to the ASX, they've been very, very simple but kind of promising. Like, here's in 2 paragraphs, here's how we've been going and things are good. An updated outlook. And it's been pretty reassuring to see some of the companies doing well. And I think a company that we spoke about on the podcast a while ago, I don't think you and I have spoken about it, but a company called Playside Studios. This is a company that does video games. It's a video game developer here in Australia. That's been doing really well lately from a share market perspective. So it's been some good results out and some good updates. So it's just been really busy. We've got a few companies to talk about today. We've got a lot of US companies, and I know one of our flag favorites is Tesla on the show. So I know you've got a bit to say on that. Another thing is we're not going to talk about it, but just by saying I'm not going to talk about it, we're talking about it, which is just Apple obviously came out with its new product this week, basically revamped MacBook Pro range. So really exciting. Maybe in a few weeks you'll see me recording on a MacBook Pro. But I don't know what you recommend. Sorry, go on.
I was going to say that, so there's some really cool stuff. I actually haven't finished listening to the M1 presentation from Johnny, but I took a couple of different, I made some jokes on Twitter. It's only Apple that can release new HomePods minis in different colors, exactly the same thing, and call it innovation. They actually had a segment on the entire thing. It was a short segment, 3-4 minutes, but they had one about the different colors and how it's going to work for the home. I think that is the mark of a company whose brand is that high. And here's the other thing. They released a cloth for cleaning stuff, I guess, for $25. You can't get one now. It's like it's backed up. It's like you have to back order for the cloth. So imagine the margin on this microfiber cloth. Probably retails, they probably source it for like 50 cents or something. You're selling it, or maybe $1 if I'm being generous. And they're selling it for 19. And that's, that's so I'm calling the cloth the new dongles, the replacement of the dongles.
Yeah. Soon when you get your iMac, you won't have the little cleaning cloth for your screen anymore. It will just be, you have to buy that separately as well. And they'll probably change the adaptability of it every year. So you have to buy another one. It's been a busy week on the tech front, in particular in the US. I know there are a few things that you want to talk about. The first one is Tesla. We mentioned it, I think it was last week or the week before, because they came out with deliveries before they come out with the quarterly. And now we've got the quarterly. So I guess we can just dive straight into that. How did you find it? How did the market find it? What are some green shoots and other things?
So the rest of the show is all going to be now Tesla, right? So all of you, the Tesla Q people, you can just leave. The Tesla bull people, you can just stay And then there we go. Yeah, so it was a fantastic quarter, like just fantastic. It was, and there are a couple of interesting things. I'll start with the nuggets that I think are interesting. Elon Musk did not show up as promised on the call, and Zach Kirkhorn, who's the CFO, he spoke like he's the CEO.
Okay.
His guy is so clear, so with clarity, he answers even those questions that are ridiculing Tesla. There was the analyst who asked them about, okay, it's good to see that Tesla has a team behind it. Of course, Tesla has a team behind it. It's not a one-man show, but he handled that question with a lot of poise and grace. Yeah, it was fascinating to see Zach Kirkhorn manage the show. It almost seems like they're preparing him to take over as maybe COO. And he'd do a fantastic. He does a very good job of explaining everything. He understands the long term, understands the short term, and very good with numbers. And he's a young guy. So that was fascinating part of the conversation. They also had two other execs on the call, but no Elon, which means we didn't have any ramblings and bumblings and any predictions. And that's a boneheaded question, things like that. So there's no drama, which is the dramaless call. But nonetheless, so that was I think one big highlight. I think it was good. It's a good change. Here's the number one thing that I took away is that the gross margin of the automotive side of the business is now at 30.5%. Okay. Other than Porsche, Ferrari, whose gross margin is 50%, as you would expect, I don't think anybody else has this kind of gross margin now. And I think the margins are probably going to go up because they still have they're still in the ramp up phase. So there's a lot of cost that they're going to be absorbing. There's a lot of cost that they're still trying to absorb because of the ramp up, right? So I think as the ramp up happens, they'll get this cost absorption happening, which would mean that I think the gross margin is going to go up even further. So this is very, very interesting. Number two thing that
oh yeah, so you go.
Yes, go. No, go ahead, tell me.
I was just going to say, I was probably jumping ahead of you, is basically the free cash flow as a result of that margin expansion. It's huge.
Yeah, so free cash flow, went up, but what also went up along with that is their spending on CapEx. So the CapEx spending actually went up to 1.8 billion, which reduced the free cash flow, I think only 1.3 billion or something like that, right? But I like to watch the adjusted EBITDA number because that sort of is telling me sort of how profitable the company can be. And that number grew 77% to 3.2 billion. And the margin on that was like 23%. So that is really, really fantastic, I think. The other cool thing is that people like to talk about Tesla as a car automotive company. It's mostly producing automotive. Actually, they're not even recognizing much of their software revenue because they think that they can't yet recognize it. So it's all getting added to a deferred revenue part, which is basically a liability, right? But what is interesting is that they took the opportunity of all the free cash flow that they're generating to pay down high interest rate debt. So their net cash position now is about $14 billion. That's very unautomotive-like and very tech-like to have a net cash position in tens of billions of dollars. And as we just have noted, that they're adding about $1 billion plus easily in free cash flow each quarter, and likely to go up as the volumes go up, right? So, they just add that cash generative machine standpoint. The other thing I was going to say is, and this is a comment again that Kirkhorn made in the call. They said that they were sort of taken aback with the desirability of electric vehicles. And this is from a demand point of view, and just the need, the people's desire to buy a Tesla. And what he was saying that as more Teslas are on the road, they just sort of become the marketing machine in itself. So this is fascinating coming from Tesla. They're the guys who are producing these vehicles. They're trying to grow as fast as they can. And they're saying that there's so much demand that in some places we have a huge backlog. We can't build factories fast enough. We can't source batteries fast enough. I think that's really, really interesting position to take. One more thing, and I'll keep the last one or a couple of other things. So people like to talk about, how, okay, fine, it's all, so now the bear story has changed. The bear story was previously this stock is going to zero, this company is going bankrupt, and now this company is overvalued, because that's kind of like the last clutch, or last straw that you can have. But you could do here's a very rough of the envelope, back of the envelope sort of calculation, right? So look at the non-GAAP earnings. So non-GAAP EPS, the non-GAAP EPS is about $5 right now, which means after the share price bump, it's probably trading at somewhere under 200 times earnings. Now that sounds huge, 200 times earnings. But I'll point a couple of things out. There are many companies that don't even have any earnings. Their PE is infinity, right? A lot of SaaS stocks, for example, would look really expensive if you applied a PE metric to it. But the way I sort of look at the PE metric, if you want to make it very simple, is to think about how quickly earnings are growing, right? So earnings this quarter jumped about 150%. So basically, the earnings are growing that quickly because of leverage in the business, underlying leverage in the business. So you're paying for a business that's growing sort of at 100% plus its earnings, about 200 times earnings. That the multiple will shrink very quickly if the stock price doesn't keep up with it, right? So if the stock price were to stay stagnant, the next year the earning would be $10 from $5 potentially, right? And then the multiple would basically fall in half, right? And then you can and this seems outlandish, but their goal is to grow at 50% per annum on average. Now that might not translate into 50% earnings growth. Actually might translate into higher or lower, depends on what the ASPs are. So ASP being average selling price. Then the last thing I want to talk about is, second last thing, is they highlight a couple of things. So they've done this insurance telematics product that they've launched in Texas. So insurance telematics means to give insurance based on driving record. So they've launched this thing called driver safety points. So basically you get points based on how good or bad a driver you are, based on the data that they're collecting. Based on that, they can offer their own insurance. Now this is an idea that has been talked about a lot in the past, but really the insurance companies never really had control over the data that's being collected in the car, right? You'd have to install a separate device or another piece of hardware and things like that. But here Tesla is collecting so much sensor data that it can actually offer the insurance, right? So the company has its pie in insurance, has its fingers on autonomy, has its fingers in, and we're not even talking about the energy component, has its fingers on AI and so many other things. So there's a lot of raw upside from all these other things that the company is doing. So that might justify the price. The last thing, which I think this is interesting, this is around, there's a lot of talk about inflation, right? So there's pricing pressure on all sorts of commodities, and Tesla has been working really hard, with their engineering team, changing firmware, changing chips, things like that, changing the software. The pressure of raw material costs, this is an interesting one, because being the largest EV producer, they have sort of signed long-term deals, right? And because they have a pipeline of factories, they can continue to sign long-term deals. That probably gives them an advantage in terms of pricing negotiations and how much of the price increase of raw material do they absorb, right? But if you are a new EV player, this is probably the worst point to be starting, because there's price fluctuations, the prices are high, and it's a hard problem to have if you are a new EV player or if you're a legacy player trying to transition, because your costs are going to be high. And if you're a legacy player, you have to sacrifice your profitable legacy business into this unprofitable business, which is with a much higher price point because you don't have scale. So it's one of those things where, they sort of have hits of escape velocity. So they are fine, but the others are not in a good situation. So that I thought was an interesting comment. They didn't put it this way, but I'm saying that I think, the cost structure of various things and Tesla's ability to sort of lock contracts over long term is a big advantage that they've got. Plus the vertical integration in terms of the cells that they're making for themselves, right? That again puts them at a significant advantage over others. So really, really interesting overall.
Was there anything that kind of swayed your conviction in the company after all that?
No, but I've always had a very high conviction in this company. I mean, the risk always remains that there's a lot of vision in this company that is driven by one man, or at least it seems like it's driven by one person. And that is always a problem, because if that one person is to leave or something happens, then there's a big factor, right? But the question really is how much of the roadmap has been, companies design things and they have a roadmap of it built. Typically, good companies would have a roadmap that goes into at least 5+ years, right? And a good example would be the Cybertruck or the Semi. They have been designed and they're iterating on it, but they haven't made it, right? And there's also things under the wraps. So that's my takeaway. But yeah, it was really good. Oh, I guess the other thing is the long-term operating margin that they're talking about, at least if you think about it on an EBIT basis, I guess. They're already hitting those margins that they had thought that they're going to hit in maybe a few years down the lane. So yeah, interesting.
I think, I think you made a comment in there about the price earnings ratio and basically how, leverage kicks in. I think it's really important for investors to remind themselves that when a business is hitting operating leverage, when it's hitting that inflection point, it's very, very hard to try and get any type of read on the PE ratio as like a overly useful metric. Maybe in like mature stage businesses, it's pretty, it's more reliable, I would say. But even then, I mean, there's so much that goes between the top of the income statement right down to earnings before you calculate that PE ratio, that it's very difficult metric to get a handle on. And I think for a business like moving as fast as Tesla, I think if you plugged it into Google, as I just did, you look and you see, it says 468 times earnings, and you're like, well, how can anyone that's sane buy this company? But then if you think about how fast the operating leverage is kicking in, how much of that new revenue is dropping to the bottom line, and all the optionality that you've just talked about. Like, we didn't even talk about the non-automotive stuff. So yeah, fascinating company, and one heck of a result. And I bet you're happy. I'm happy for another short term win. Usually there's a seldom news that happens with Tesla. I think for the last several quarters is like, the stock goes up when the production numbers come out, because the production numbers come out beforehand, right? They come out on the first or second of the end of the quarter, just the end of the couple of days after the end of the quarter. And then so the stock goes up and then it goes down. But today the stock actually went up. I think it's closing in on some record highs, so I'm happy about that, because I own the stock. I want it to be a record high. Because I own plenty of it. I don't need to buy more, so that's okay for me. I feel for everybody else. Well, as long as it keeps going up, right? One day you can handle, but everything seems to be going pretty well. So that's great, man, and good on you for backing your convictions. It's oftentimes the most difficult one. The biggest payoffs, as in Tesla for you in this case, are oftentimes the ones that are most scary for investors, and there's the most friction in that holding. So I think all credit to you for continuing to hold.
That's actually a good. That's a good comment, because those are the hardest ones. That the investments which have friction or noise or a lot of debate, actually those can be really interesting ones. Yeah, I like that.
Yeah, absolutely. And we saw that with Afterpay here in Australia. You see it all around the world with many different companies. So fascinating. I've actually, to bring it back to Australia now, there is a company here which I thought would be worth talking about. It kind of made headlines this week, and definitely it was very popular in FinTwit. So I'm going to see if I can share my screen with you again, which is this one just here. And this is Magellan Financial Group. So Magellan, I know Magellan, but for those that don't, Magellan is basically a funds management business that has, in the last, say, 2 to 3 years, transitioned out of funds management, where it has kind of led the pack, it's fair to say. And now it's transitioning into kind of like what was called principal investments, and kind of just different positions. So what I mean by that is, instead of just taking people's money, charging a percentage clip on the ticket, they're now diversifying that side of the funds management business, but also diversifying into holding stakes in other companies. And I think the big one that's on most people's mind is a company called Barrenjoey, which you can see in the AGM address, which came out this week. And basically, the founder, Hamish Douglas, co-founder Hamish Douglas, basically came out and said, it's profitable, and most people didn't think it would be profitable right now. So it's actually a really interesting business. So if you've been on an analyst call here in Australia, as I have been on many recently, there's oftentimes a Barrenjoey analyst on there, and I feel like it's almost like a requirement for them to ask a question on a call just to get their name out there. But they've got a series of these smaller investments. So Guzman y Gomez, you can see they made $103 million investment there, $23 million into FinClear, which I believe has since raised capital at something like 4 times that amount. And here's Barrenjoey down the bottom here. So it's basically an investment bank. Hamish Douglas, who, as I said, is the co-founder, prior to Magellan, he actually was an investment banker. So he's kind of got deep experience in this market. And they basically come out here and said profitable for the 3 months of FY22, which caught a lot of people off guard. And obviously, if you think about the likes of Macquarie here in Australia, or even just some of the big accounting firms, and the amount of value creation that they absorb, kind of being at the center of the hourglass of that is finance. This is a big opportunity for Magellan to diversify outside their core business, which is traditional funds management. And traditionally, that has only been in the global side of the business, this global equities franchise. So you can see the other thing here, I would say, is that they've outlined 5 key areas of growth for the business. And many of these businesses, while small, are starting to gain some meaningful traction. So they bought Airlie Funds Management, which obviously came with some great investors like John Sevier. Gerald Stack, who leads the global infrastructure unit inside of Magellan, has been there the whole time, and I believe the whole time. And that business is a huge multi-billion-dollar business as well that's still got some potential. And I guess at the end of the day, there's been a lot of criticism thrown at Magellan recently because of their underperformance relative to the benchmark, because Magellan makes money based on asset management fees, but also performance fees. It's important to remember that Magellan was basically founded on the premise that you can protect some of the downside, but also enjoy the upside of markets. And that's what every fund manager says, right? But they actually have stuck to their guns for the most part. So they've said here that their global fund, which is where they make the majority of their money, has protected to the downside considerably by saying it's only been exposed to 45.3% of the market downside, and yet it's met its 9% hurdle rate every year. So all in all, this presentation and this update from management really just kind of pleased the market. I think shares rose about 6%, I believe, off the top of my head. And Magellan still has many ways that it can grow. It's still extremely, extremely profitable, as are all fund management businesses at scale. It's just that the performance fees haven't been as fruitful. And I think when you're valuing a company like Magellan, I think that the first point of call is maybe to be a bit more conservative and try and value the core business without the performance fees, and then try and value some of this optionality separately to see what your downside could be. Funds management can be a fickle business. Clients can pull their money out of Magellan and go across the street to another fund manager, but based on everything that's been said so far, it seems positive. And the writing, this probably my final point, is that the writing's been on the wall a little bit for Magellan, in the sense that it's already, if not the biggest, it's one of the biggest fund managers here in Australia, and the global side of the business in particular makes up the majority of this $100+ billion of funds under management. And so there is a limit for funds. When you get too big, it becomes harder to manage, as Buffett's always said. So Magellan is a beast now, but they still have all of these green shoots emerging. So it's a really interesting business. It's one I'm actually taking a look at now. And the guys on Rask Media have actually written a fair bit about it. Like, here's Locke's article on Rask Media. So I'd encourage people to go and listen to more of that, or even have a look at the AGM themselves. So that's Magellan. It's on the ASX under the ticker code MFG. I think it's offering a dividend. It pays out the majority of its earnings as dividends. Funds under management, thanks to market influence and still getting inflows, the business is still growing. So the core business, and it's got all this optionality in it. So it's a really interesting business with a fully franked dividend. And I think in Australia, it's pretty hard to find something that's reasonably valued. I think if you took the point between AGMs, I think shares were down 36% year over year. So meanwhile, it's still as profitable as ever. So really interesting business. Maybe not quite the upside of Tesla, but still a really interesting business it's found to run. So I like it.
Oh, one question about Magellan. So how much do you rate the key man risk here? Like, I mean, Hamish is like the big name. He's very famous. He's well known. A lot of attraction to Hamish, right? What if he decides to walk? I mean, someday he would decide to walk, I would assume.
Yeah, I mean, he could do what Kurt Nelson did has done at Platinum, which is, I think if you go, at least last time I checked, if you go on the Platinum website, it still says Kurt Nelson analyst on the website. I don't know if that's a placeholder or not, but yeah, I mean, I think he's still quite a bit away from that. And I think it's an interesting point that you bring up, because I think at Magellan, he's done a really good job of gathering really smart people that may not necessarily want the limelight, but also are incredibly skilled and can take the reins over time. So like I think they've got better at first building that, and then now starting to give those people a bit more exposure. Like, so if you look here, a bit more responsibility, I should say. So Hamish is still one of 3 portfolio managers in the global equity strategy. But if you come down into these 5 key growth areas that I outlined, you can actually see they've made an emphasis of showing you who is leading these business units. And I think that's an attempt by them to try and show you, there are many talented people within this business. So, here's Ely Funds Management, for example, John Sevier, Matt Williams, and Emma Fisher. And you keep coming down, and there's more: Paul Allen, Dom Giuliano, and then you got the core series, which is more of a systematic approach to investing, and so on and so forth. And they only have non-core stakes on those new business, not non-core, but they're not like running the companies of those investments that they're making in new businesses. So there's no kind of onus there on Hamish himself. So overall, I'd say, yes, I agree, because he's kind of the talisman of the company, and people know Magellan with Hamish. But I'd say that they're getting better at that. And like on the infrastructure side, Gerald Stack's been there a very long time, if not the whole time. And I've seen him present and do all those types of things, and it's excellent. He's excellent. So it's less of a concern for me now than it was in the past, if that makes sense. Yeah.
Cool. Like it.
Cool. So that's Magellan, MFG on the ASX. There is another interesting company that we wanted to talk about, which I don't know much about it, because I am not a user of the platform, nor do I follow the company that closely. So I'm hoping you can fill me and potentially a lot of listeners in here, which is quite a provocative note we've got here in the run sheet, which is the cookie crumbling Snapchat's results? So I'm interested to hear what you've got to say on Snapchat.
Well, I'll share the screen in a second. But this is not a company that I use either. I'm not on Snapchat. My daughter uses it a lot. Apparently, all the kids love using Snapchat. So the cookie crumbling is sort of a metaphorical way of saying that there's a lot of changes happening in the cookie world, right? So first-party cookies are okay, but third-party cookies that are widely used for tracking. Owen wants to buy those boots from the Thursday Boots company. So he visited the site, but he didn't buy it. Then he goes to some other site, and then he goes to some other site. And now all of a sudden, all the sites are showing him the Thursday Boot company's ads. Well, that's basically retargeting, and that happens by having these little cookies that follow you around. So Apple has basically made a change. And so this is an iOS change where every app now pops up that says, do you allow us to track you? And users have the choice of saying no. and that has, I think, a big impact on sort of how retargeting would work. So basically, third-party cookies are becoming difficult. So, and various people had estimates of how this is going to impact their business, especially those businesses that are free services where, free means you are the product. They've all had challenges with the new system, right? So
that would be
Snapchat
like
actually,
Google, Facebook, Instagram, TikTok, all these ones.
all these free services, Pinterest and the likes, right? But the thing is that this change really, I think, affects some companies disproportionately versus others, right? So a company like Google, because you log into, like, YouTube, you log into Gmail, you log into so many different Google services, right? So it's like Google has got a lot of first party data on individuals. And, you could argue that Facebook has got a lot of first party data. So it's probably not as, but it still impacts their ability to retarget because they don't see that information of you being on other places. But, some companies are worse off than others, right? So what was interesting for me is if you look at the results for Snapchat, it's actually a pretty solid result. So I'm going to try to share my screen. Let me see if I can. I think I can. Boom. Okay, share. All right.
I can see it.
Okay, so if you look at this, so daily active users, these are people who log in every day for a certain amount of time. That increased 23% year over year to 306 million. Now, that's pretty solid. Revenue, on the other hand, increased 57%, right? So lots of ads going through the system to like $1 billion, right? That is pretty good. And if you look at the adjusted EBITDA number, then that improved 200%. So there's operating margin, like this leverage in this business, generated a small 52 million free cash flow in the quarter as well. So that is all great, right? And then Ivan Spiegel basically says, I'll highlight this. We're now operating at the scale necessary to navigate significant headwinds. And this is what destroyed the shares after hours. The shares were at one point down 30% or something. I think they recovered a bit, including changes to iOS platform that's impacting the way advertising is targeted, measured, and optimized, right? So that really, that actually pulled Facebook shares down, it pulled Google shares down, pulled a bunch of other ad tech shares down as well. So I think that's interesting. What I do think is funny is this part, as well as global supply chain issues, blah, 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 blah. Come on. I get it that the people who advertise probably are impacted by supply chain, and maybe they, but supply chain is never going to stop Coca-Cola from advertising. Coca-Cola is going to still advertise. So I don't know who these people are that are, are not going to advertise because of supply chain. And Ford is going to advertise whether or not they produce enough cars. They're going to advertise. That's what they do. There is an advertising budget, and I haven't seen advertising budgets come down. So this, I think, is odd. But I think people are spooked about this change, and this is really, I think, still early stages of the journey in terms of how ad platforms are going to shift. So that's, I think, the real things. If I expect substantial volatility in any business that is dependent on sort of iOS apps and ads and usage on iOS platform and ads. And we know that while iOS has a relatively small share of the global market, 15%, maybe 15-20%, whatever it is, versus say Android, it generates actually the lion's share of the profits and things like that, because that's mostly well-to-do people use the iOS platform. Like I said, mostly there are people, of course, well-to-do people who use Android, but that's how it has shaped
it's a generalization. That's fair.
It's generalization. Yeah. So that's really it. So I think this is like, the other thing I want to talk about here is a little bit about valuation. So this company before the drop today was worth $120 billion. So you think about it this way, generating $1 billion of revenue, ad revenue, let's say. Most of it is ad revenue. They have some other things that they're doing in augmented reality in terms of, they have some glasses. They produce AR glasses and things like that you can buy. But you're $1 billion run rate. So let's call it like, 4 billion annually, and you're growing at say 50%. That's pretty solid. But that mark in the company is now valued at 120 billion. It's not really valued at 120 billion, I guess, tomorrow when the market opens, but that's something to keep in mind. That seems like a pretty high valuation, at least on the surface of it, but maybe, it's justifiable if the revenue can continue growing. So I think that's what the market is basically saying as well. We don't know what this change is going to do. We were happy with this valuation because of your growth and run rate, but if your growth is going to slow down because of these changes in other platforms. The final thing I want to mentioned, use this as an illustrative example is, and this is neither here nor there, but something to think about is companies that control primary technology. So if you think about, Google controls the Android platform, has search as almost like you can think of as a primary technology. Companies that control primary technology have a lot more sway than companies that don't, right? So if you build on top of stuff, you're at the mercy of those people who build the primary technology, right? And then a great example, you talked about M1. I mean, today Apple is making better chips than Intel and potentially better GPUs than NVIDIA. Well, that's because they control the underlying OS and therefore they can build the hardware and the software that works together. So a lot of companies want to, and this is one of the reasons why, Facebook wants to build hardware and, Google has its own chips. It's basically that underlying hardware, software integration, and just having more control over primary technology. So those are things I don't want to talk about from Snap's point of view.
Can I just ask a question? Do you have the gross margin in front of you there? Or do you know?
I think if we can find it very quickly, let's see. There should be a financial statement at the end of this thing. Gross margin should be relatively high. Let's see. Come on. Here we go.
The reason I ask is that sometimes with these platforms, it's interesting to look at how they scale because some of them build on different infrastructure underneath. Some of them manage their own infrastructure. So there's spend there, and sometimes there isn't. So I mean,
we have it here, right? So it's $1 billion, of which cost revenue is about 400 million, right? That's pretty high at roughly 60%.
That's pretty good. Yeah.
Roughly. Yeah. A little bit less than that. So, I mean, they're paying a fair bit to, I guess, cloud providers for hosting and things like that. So it's not software like 80%.
Yeah. No, it's not. Okay, that's interesting. The other question was, and this actually is on the back of Vinoth has asked something in the live chat here. He's basically asked, do you see others following Apple in making their own chip?
Yes, we sort of answered that. Yes, Google already has its, Tensor chips, and I think Facebook has its own. So I think Tesla makes its own. So it's like basically they design the chips, they don't build it, then it's built by third-party foundries like TMC or Samsung, and most of them are built using ARM's IP. So ARM is like sort of the critical layer that's used there. So yes, but I think the interesting thing with building going down the stack, so going down the stack as in from developing applications is up the stack. Right? Then writing the OS is lower, right? So you build applications on top of the OS, OS being the operating system. And then going further down is the hardware, right? So it's the hardware on which the OS runs. That's the chips, right? Going down the stack is relatively easy, but building expertise to beat out people like Intel takes decades, right? It's not easy and not straightforward. And, you see simple things like, the new Pixel phones are out and maybe they're comparable performance in terms of the Apple's, 13 Pro Max, whatever. But the interesting thing would be that Apple will get similar performance out using, say, less memory and less space than somebody else because, they just good at optimization things. And that probably doesn't matter for a smartphone, but it probably matters a lot when you're designing wearables. Right. So as the form factor changes, the ability to design smaller, faster, cheaper, highly efficient, it just becomes it's a skill of its own, right? And I think in that game, Apple is just miles and miles ahead of almost anyone. Right? So that's that's my observation at least.
Yeah, I think we saw that on demonstration this week when the company unveiled its M1 Max. So basically, just a huge CPU, GPU combo that's just blown everything out of the water. And they can do that when it's on a battery or when it's on charge. So yeah, I think we're starting to see the fruits of that. I think this round of MacBook or just upgrades for me was a super strong insight into how powerful they can make the platform from their own chips all the way up. So really interesting. Another company that, well, it's actually worth noting, I should say just on the back of this, because I did actually take a look at the Snapchat stock price after knowing that we're going to talk about it. And it's just since 2020, it's been, happy days. Everything's been going really well. And then all of a sudden out of nowhere, it's down 21% after hours. So I think that's a really interesting thing. But the other one that I guess has copped a bit of, not criticism, but it's been a bit volatile until recently was Netflix. But it's just now it's hit an all-time high after a rally in the past few weeks. And I saw that it's basically come out with results for the third quarter, and they're pretty strong. They seem pretty strong. But year-on-year growth of 16% in revenue, operating income of 1.7 billion for the quarter, 23% margin, a net income of 1.4 billion. So it gives us diluted earnings per share of $3.19. Memberships, importantly, up 9.4%, which is really strong, I would say, coming out of COVID. Really, really strong numbers here. So I guess I'm just interested to get your thoughts on this. Do you have any kind of expectations for this, and what did you pull out of it?
Yeah, so I thought that was exactly like you. I thought they're really strong. And what I think is interesting is that, a lot of content is coming online, right? Like Squid Games is probably a hit and things like that. So as more content comes online, and this is like a hit machine sort of thing, right? With the streaming players, the more sort of content you produce that results in those social media, water cooler chat equivalent, whatever you want to call it, the more subscribers join. And, that's been the Netflix story, and they're really executing that well. The only thing that I find, I guess, what is worth thinking about is, I guess this is a tech lull sort of thing, is Netflix has been making some forays into games and, gaming, and, they're buying some storybook franchises. So they must have something else that they are interested in, that they are looking to do with the content that they're building and the IP that they've got. Because if I just think about streaming, right, the streaming then looks like it's, the analogy would be, it's like an airport, right? Whatever you do, it's ultimately basically got a runway, and there is a huge debt that facilitates the infrastructure called the airport. Because in Netflix's case, it's basically, it's revisiting cable TV in another way, right? Because you've got all this debt for content that they're taking on. So while it's producing net income, but it has got a lot of debt that it's building and building and building. So it really needs, at some point, it would need to do something that makes it more tech and less media, because it does have a tech-like multiple, right? And
it does.
So I don't know. Yeah. So that's the thing I always think about now, because now that we are past that sort of the very high sort of, growth. I mean, how much is, there's still a lot of runway here, but you're going to grow at, 15% from here or so, roughly you'll be adding that kind of, numbers growth, right? And there's only so much you can push in terms of price, and so that's what I think is interesting for Netflix. But there's no other special takeaway other than that. I think you covered almost everything.
It's always interesting to see what's most popular on the platform. So the top 10 series by the number of accounts watching at least 2 minutes in the first 28 days. Here we go. We've got Bridgerton season 1, Lupin part 1, The Witcher, Sex Life, Stranger Things 3, Money Heist, Tiger King, The Queen's Gambit, Sweet Tooth, and Emily in Paris. I actually haven't watched many of those. Tiger King I definitely have. So I thought Squid Game would be giving it a run for its money, but maybe not. Maybe that's an acquired taste, and it's probably, let's be honest, it's R18. So
yeah, I would think that would show up wouldn't it show up in the next one?
I'm guessing because it probably didn't go viral until after the quarter.
Yeah, that's what I'm thinking too. But yeah, you're right. Like a lot of these things, I don't even know what they are, but I mean, those hours watched are pretty high.
Yeah, they're huge. So here we go. Squid Games. They say in the quarterly update, Squid Games popularity is truly amazing. This show has been ranked as our #1 program in 94 countries, including the US. So yeah, more than 42 billion views across like TikTok and a bunch of other stuff too. So really fascinating stuff. And you can see the growth rates, year over year. They do provide this kind of cohort. They kind of show you year on year, like how we're going with net ads. And you can see that it is, other than with COVID, this year is slowing down a little bit. but it's still growing quite a bit. And that's the key point, I think, is it's just got to adjust to that, right?
Yeah, that's right.
Yeah.
And
it's not a business that I own shares in, but it's fascinating.
Yeah, in one of the things that talk about in the letter, they're actually one of the great things they do. They produce a very good shareholder letter, and then they do talk about testing games in select countries. So I think this is the thing to watch. Is this the Netflix 4.0 in terms of evolution, right? So they went from the DVD, shipping the DVD, to actually streaming, to making their own content, to making content of various kinds, to now going international, to then now doing games. So I think this might be sort of the interesting thing to watch.
Yeah, indeed. I think their culture deck, which you can still get online, you can see that it's really enabled them. If you read Hastings' book, and you realize that the way they built the team and the culture at Netflix is such that the culture is what has allowed them to persevere and to transition from mail out DVDs to streaming, and to deal and mobile, and deal with all of these challenges over the years. So it's a really interesting facet of an enduring business model. So great stuff. Okay, we're going to switch gears here right before the end, which is we're just going to talk for a little bit about interest rates, which is, I think, the first thing you and I ever talked about on the show when we started doing these weekly shows, is basically interest rates and how that impacts investing. And I just want to hand it over to you here to throw it to me to kick things off. But interest rates, are they rising? And I guess what's the impact of rising rates?
Yeah, and if people can hear some lawn mowing activity happening in the background, then I apologize.
No, it's good. It's all fine on my end.
Okay, so there's no problem. Then I can just keep talking. I can just ignore the noise that is coming through my head.
Yes.
Giving me a spin. So interest rates, I mean, there's a lot of chat about interest rate inflation. What I thought was interesting, I think we didn't talk about this, was the Bank of New Zealand, or the Reserve Bank of New Zealand, increased rates because they have a hot housing market, and the fruits and vegetables are expensive, and everything is up on the rise. And they think that maybe they need to cool down the economy a bit. And the thing with interest rates are sort of the discount rate that I look at, or a part of the discount rate, right? So I mean, how much more do you want returns from equity, because you're taking some risk, right? If you can get 5% returns from by putting your money in a term deposit, then you would ask for at least another 6-7% more for putting your money on the equities, right? But if you are going to get like close to zero for putting a term deposit in, then you'd probably be happy maybe with a 7% return from the stock markets. It has and then the discount rate matters, because that ultimately matters in terms of the valuation, right? So it basically pulls the valuation up or down that you would be willing to pay. And of course, we should all think about long-term, what the average sort of interest rate is going to be, and that sort of should decide how much we're paying for equity. But so there's been a lot of projections about interest rates going up. One of the first ones to pull the trigger is New Zealand. So the question is New Zealand leading the pack, right? And we know that the U.S. Federal Reserve is looking to increase interest rates sooner than they thought. It's again partly driven by the inflation print that has been there. Although I would argue that a lot of the things that we are seeing in inflation are one time, because if fuel prices have gone up because people were not driving enough, and now we're sort of still trying to get back to pre-COVID levels, then that's a one-time effect. The same thing with supply chain distortions. The supply chain distortions are one time. In Australia, it seems free childcare is a contributor to inflation, because now it's no longer free. So therefore, the childcare is something that people are having to spend on. Well, that's causing inflation. But is that price going to go from zero to however much, $30 or $40 you're paying per hour, or $50 you're paying per hour? It's not going to become 0 to 50 to 100. You know what I mean? So a lot of those things seem to be one time, but there's a direct relationship to there is a relationship to valuation. So,
and does it concern you? I mean, talking to people around me, I made a comment at the top of the show there about fuel prices being $1.85, which is very high for Australia. Does this talk concern you at all?
No, not really, because I mean, as I said, as a long-term investor, you really have to take the view of how things are going to look, say 10, 20 years, right? And it's very hard to make a prediction, but I've been of the view that we are technically in a deflationary type of world because of technology and globalization, right? Those sort of push prices down. So I don't think rates are going to go up that much, but they will go up. So I always factor that in a bit. And then I sort of try to invest in growth. I would invest in growth businesses that have long runways and that have large TAMs. And then I try to invest in those businesses that have pricing power. Like, so if it's a Tesla, they're just going to increase the prices to offset some of that, or they're going to squeeze the suppliers as much as they can to keep, the prices rolling in, which, Tesla has done, or an Apple will do, right? So I think you're going to find those businesses that have more control in their pricing because, and those businesses that have long runways. And then I think all of these other things sort of become a bit of a noise. But I guess again, there's going to be short-term volatility that there's nothing, I guess, we can do anything about.
I'm just looking at the 10-year Australian bond yields, and they have gone up a bit recently from $1.20, not $1.20, 1.2 to say 1.65, 1.8 recently, and this is a pretty quick succession. And generally, these long-term yields are indicative of where kind of investors or the market sees the pressure coming from when it sees it. We saw this similar kind of rhetoric at the beginning of the year and late last year when the prints were really high, the inflation prints were really high, as the world was coming out of. Australia might not have been coming out of lockdowns, but the world was, and when we saw some really interesting figures there. From where I see it, I'm sorry, go on.
Just one quick clarification, right? So one of the things that is important, I think, this is maybe an academic point, but the bond yields that you're looking at and I'm looking at are sort of the secondary market bond yields, right? So this is basically the bonds that the governments have issued that are trading freely and that are kind of indicative of what the cost of borrowing might be for a future bond that the Australian government might sell or the RBA might sell. Now, what I find funny though is when a government sells the bond, there are people who are snapping these things off for negative yield. So the yield goes up in the real world or in the secondary market, but when someone is selling it, oh yeah, I want it, I will pay you money to take, for you to keep my money. So I really don't get it, but anyways, that's just a side point.
Well, yeah, I guess in the global, if you're allocating to Australia in the global perspective, maybe that's still a pretty tempting bet considering what you have overseas. So maybe that's something too. Broadly, I just think it's pretty hard to see markets coping with, as you said, like a rapid increase in any types of rates. And the longer term average is still quite a way above where we are today. But to even get back to that here in Australia, and I'm sure it's the case in New Zealand, would be very difficult to do relatively shortly. So I think this brings in the whole conversation around modern monetary theory, which is probably a whole nother podcast. But it's just an interesting thing to see that our friends across the water are already raising rates. I think the RBA has been kind of a bit more conservative with its forecast and with its outlook to say, everything's okay. Business as usual for now. So we'll see where it goes from there. I'm just conscious of time because we've only got a couple more minutes, but I just thought I'd show you this. I actually received this during the call. I don't know if you can see that, but my order is ready.
Yay!
So
another
I can go and pick up my Starlink
satellite internet.
There we go. It looks like I'm about to become a Starlink owner. So I'm very, very proud of that fact, and I can join the club, mate.
So here's a problem. Next time when you have the Starlink working, and if the Zoom is not working, then we'll have to decide who to blame, right? We can't blame Starlink because that's fantastic. So we'll blame Zoom.
That sounds good because I don't own shares in Zoom. Actually, I don't own any in SpaceX either, but yeah, wonderful.
But yeah, we'll blame Zoom.
Yeah, mate, it's always a pleasure to catch up and chat like this. So if people want to find out more about what you're doing at Seven Investing, where can they go to to get your recommendations? There's one
Yeah,
coming out
cool.
soon.
There's one coming up soon. Yeah, exciting. So 7investing.com/subscribe. Use the Rask code. You get a bit of discount on the first month. And if not, just talk to us on Twitter. If there's no pressure. No pressure.
No pressure. We are very much active on Twitter, Anirban and I. So if you do want to say g'day, you can, and you can recommend topics for future episodes. Normally we'd get on Twitter and bang the drum during the session, but we didn't today. But if you have any feedback for us, we'd love to find you on Twitter. And you can find out more about what I'm doing at www.rask.com.au. So, mate, as always, it's a pleasure to come on and talk investing with you.